afternoon. Garrett with the shiny head, just like me. My favorite, Brian with the gorgeous head. A little bit jealous, but that's all right. Look, we need to talk about something that I keep hearing about all the time. Like people love investing in mortgage-backed securities, especially residential. We'll stick to that. But there's a difference, right? I can buy a new issue home or I can buy a home that's been around for a while. There's lots of different packages of this stuff. So maybe we'll just start there. Like, why wouldn't I buy a new issue mortgage backed security? Why would I buy a seasoned one? What is really the difference between these things?
Yeah, I mean, I think there's opportunity in both, but there are some major differences. The first, maybe I'll come back to in a second, is the seasoning of the collateral. Typically, when people buy a home, they put down 20%, give or take, and then that gets soon after rolled into a security. So if you're buying a new issue security, you're probably buying it around 80 LTV, loan to value. Where if you're buying one that's 10, 15 years old, that homeowner has been making payments on that house for a long time, and maybe now you're buying it at 30 or 40 LTV, where the homeowner's got 60, 70% equity in the house. And so that's a major difference. The other though is kind of more in the bond math and structure of things. Typically, mortgage yields are a little bit higher than what you would find in, say, the treasury market, even in like agency mortgages where there's no credit risk. And that's because of something called convexity. Bond guys like to make up big words to explain simple things. And convexity, what that's explaining is that mortgages can get hurt if rates move either way. So let's say you're in a let's just say the marketplace yield is 5%, and a new bond comes out at a price 100 at 5%, and let's say interest rates go up, and now it's a 6% market, but unfortunately you're holding a bond that's only paying 5. So when people look at your bond, if you like say, here, I want to sell you my bond, at 5%, they're like, well, I can just go get a new one at 6. So I'm going to pay less for your 5%. And that's pretty much true with all bonds, whether it's mortgage or not. If interest rates go up, the price goes down because that bond's yielding less than what the market demands. But now the flip side, if rates go down, a treasury, let's say, now you own that 5% bond, and now the market is demanding 4%. Well, your 5% is worth a lot more than what you can get new. So, you can demand a premium for that. Maybe it's 101, for your bond. But in mortgages, you're short an option to sell the house. The homeowner has the option to sell. So if rates go, way down, then the homeowners sell. And so, yes, your bond goes up in value, but a lot of it refinances, and so your bond shrinks, and you don't get it all. And so so mortgages tend to be sold initially at a higher premium, or higher yield, I should say. One of the ways you can mitigate that is going back to the seasoning. Your original question is with seasoning. In the legacy, what they call legacy space, these are bonds that were issued 2005 to 2007, typically. So now you're talking low LTVs, 60, 70% of equity in the home kind of situations. And those bonds are sold at a price that's less than par, in most cases, depends on the bond. And the bonds that we've trafficked in, that we've bought recently, are around a price of like 75. So now if rates go down and people refinance, well, when they pay off their mortgage, they're paying off the entire amount. So you're getting 100 cents back on a bond that you paid 75 cents on the dollar for. And so you benefit, when rates go down, probably, more than if it didn't have this convexity, sort of issue. And plus, even in between legacy and today, a lot of those bonds were issued when interest rates were near zero. And so mortgage rates going from 6.5 to 5.5 isn't going to make homeowners refinance. They're still in a super low mortgage, and so it doesn't really drive refinancings or anything. So one of the ways to kind of mitigate, the risk in interest rate movements, especially a day like today when you got half the world telling you the Fed's going to hike and half telling you they're going to cut, and you're not sure which way it's going to go. Season mortgages reduce a lot of that risk.
Brian, let's talk a little bit more about that. So within this thing, you guys have talked about credit support, excess interest. Maybe just give us a little bit of a walkthrough how that works and who's involved in that value chain, who's getting yield, who's getting distributions, who's receiving income along that, and then how does interest rates impact excess interest and credit support?
Sure. Well, it was interesting back in the kind of early aughts when a lot of this pre-GFC, where a lot of this mortgage product was being made, a lot of it was floating rate, and there'd be a component of floating rate versus fixed rate collateral, right? It was probably 20% fixed rate and 80% floating rate when it started. And that is probably pretty much flipped around at this point, right? So you've got most people in a fixed rate mortgage that are remaining in the pool. On the other hand, the bonds that are financed or that are backed by that collateral are mostly floating rate, right? And so when we had this, rates near zero, as Garrett just mentioned several years ago, or in the teens, it meant that the coupon being paid out to the bondholders was much lower than the amount of interest that was coming in from the mortgage collateral, right, or the home borrowers. And so that difference between those two rates is excess spread. Okay, and so on one hand you think like, well, if that means that my bond coupon is low, isn't that a worse thing? Well, it actually, in these particular cases, because you had so much excess spread, it allowed you to go and apply that excess spread to repair prior losses on a lot of these bonds, because going through the GFC, many of the bonds had suffered losses. Okay, and so this excess spread, or just think of it as extra cash that wasn't directly applicable to bondholder interest payments, that excess interest stayed in the trust to repair bonds in the trust, and thus a bond that you thought you were buying that had a limited size of current face because it had been written down, you could actually get a lot of that current face expanded, and you'd get back more bonds than you thought. Okay, and so when we talk about bonds getting back more than par, or when there have been past interest shortfalls, right? And this excess spread is available to repay some of those interest shortfalls and recapture some of those prior losses and write-backs. That's how you end up getting more than par back, okay? And so, in bonds, one thing we know for sure is that things never move in a straight line, right? And that's, because of the first derivative and the second derivative, convexity, and all these things anyway. But to the extent that you thought you were buying a bond at, 60 or 70, and you thought, oh, great, I'll get par, and that's 30, 40 points of appreciation over time. That's great. But actually now with the buildup of credit enhancement, or in effect, the capture of a write back of prior losses, maybe I'll get 110 on this bond or 120 or something. Then you're talking about a lot more optionality and upside because of that price component being recaptured. Okay. And, over, I'd say, obviously in 22 through 24 even, right, in this kind of higher rate regime, in particular where front end rates were much higher, so we didn't have that big difference as I described for excess spread, right? Because front end rates went up, now you've got a higher bond coupon, okay? And so the interest that comes in from the home borrowers, right, that actually is now more matching what is going out and being paid to the bondholders, right? That excess spread has shrunk. Okay, and because of that, you could not recapture a lot of this right back and a lot of the shortfalls and that sort of thing. Now that we've had rate cuts in the end of 2024 and at the end of 2025, that excess spread has increased. Okay, so you're turning these mechanisms back on, which provides some great optionality for this upside that we've been describing.
Super helpful. Okay, so let's go back, Garrett. We'll use your example. So you said in this legacy case, we can buy a bond for 75 cents on the dollar. We know that bond math, eventually these things will mature at 100. So we'll just do simple math, 75 to 100 is 25%, right? 25% increase over 5 years. That means 5% a year, but there's no straight lines. But if I understand what Brian's saying correctly, this might not par at 100, this might par over 100. So then the question is, how do we know? And when do we know what this actual par rate will be?
Yeah, that's the magical question, right? A
Mm,
lot of that depends on interest rates, as Brian laid out. If when interest rates are high, that kind of excess spread, excess interest, extra cash goes away, and so then you're looking at more like going from 75 to par to 100. But if rates go lower, or even right now, at 4.57 on the 10-year and 375 or so on the front end, then we're capturing some excess spread. But if there's a Fed cut and rates go lower, then you're capturing more, and it starts to look like 120, 130. So the way that bond guys typically do it when they're trading is, obviously we all have models. There's programs we run these bonds in, and those models pull in what's called the forward curve, similar to the yield curve, except for these are the rates going forward that the market expects the Fed fund rate to be. And instead of the 10-year, it's what's the Fed fund rate is going to be in 10 years. And because really you could hedge that, so that's the right number to use. If you wanted to take that risk out, you could hedge those rates and buy the bond, and you would basically lock in your spread, and without the risk of rates in that sense. So these models pull in that forward curve, and then it calculates the excess spread that you're going to get over time. What the terminal value is going to be. Is it 110? Is it 120? Is it 200? I've seen bonds at 300. And then using, as you laid out, the bond math. If we're going from 75 to 175, we've got 100 points to collect over 5 years plus the interest, and then you can back into a price. And so to your point about things, and Brian's about things not moving in a straight line, as soon as that forward curve changes and people run the bonds, the price changes dramatically, because they already because you could hedge that out. So a lot of times those gains get pulled forward. I know especially today, when you're talking about investing in bonds, and you go, why would I invest in bonds when I can make 8x on Micron, whatever, bonds, I don't care about, 8%, in every year. If it's a 10-year bond or 7-year bond, and you pull all of that forward one day, you can get big, double-digit moves, in short order, even in bonds.
Okay, so let's close on this question here. Okay, I'm a noob, right? So you got to tolerate my questions, Brian. Sorry about that. We talk about in the bond world, fixed income world, duration quite a bit. I have a simple version of duration, right? 6 years duration, 1% move impacts the holding 6%. So what's the duration on these things, and how do we think about it? And what rate is it tied to? Is it tied to a 10-year, 30-year? Mortgage rate duration, this SOFR thing? Like, help us think through that process a little bit.
Well, it's actually funny, and as usual, there's not going to be a simple answer to it, right?
No simple answers. Come on, Brian.
And a lot of these, because as we mentioned, a lot of these bonds are floating rate, right? And so you think, on a floating rate or a coupon that changes every month, your duration should be pretty low, because in theory, as rates move, that coupon's going to move as well, and it'll kind of keep you around par. But given that a lot of these bonds are at a discount, right, and that the coupon impacts this excess spread, which impacts the amount that you can recover on writebacks and on shortfalls and stuff like that, there's a lot more dynamics at play for a lot of these securities. So they don't really move with the same sort of straight line 6%, 6-year duration, means 6% up or 6% down, as you described, right? A lot of these, for example, during 22 through 24, because front-end rates went so much higher and that decreased excess spread, that actually made the bonds trade a lot longer, okay? And so their duration, they got hurt much more because rates went higher and shut off a lot of those features. Now that at the end of 24 and 25, as I mentioned, we had those cuts, a lot of those features are coming back on, okay? And so that means that the rally that they experience as rates go lower is also more pronounced, right? Or in effect, that it makes it look like the duration is longer because a lot of those features came back online. Okay, and so they traded with a little bit longer duration as rates have gone lower. At the same time, kind of in localized moves, you probably see it move with the duration varies. I'd almost call it similar to the market, right? And if you think of the ag, something representative of that is, this kind of 5.5 or 6 year duration. That's probably a reasonable estimate for a first order move, or a simple move from basis points translated to duration. So that's very convoluted answer for what you
No, it
as
has to
a
be
pretty simple
convoluted because
question.
you used something there, and Garrett, I'll let you close. You said looks like a duration of this. So what are your riff on that a little bit longer and we'll close it there. Brian says it looks like a duration of, but it sounds like it looks like a duration of depending on a couple of variables before that period of
That's
time.
right. That's right. I mean, and quite honestly, it's why we have a job.
Yeah,
Now,
good. Well, I'm
if
glad
things
you have a
are super straightforward, AI can take over, monkey can do whatever. That's even seasoned bond guys. Some of them look at mortgages and just scratch their head. It's something you have to be well versed in this universe. Yeah, but and that's actually a better, more complete definition of the big scary word I threw out earlier, convexity. And convexity is explaining how duration changes. So most bonds, the duration is pretty, more or less, about the same as rates change. And when interest rates were near zero, these bonds probably had a under 2 year duration. Because they floated, they were floaters, and the impact of that excess spread, there was so much of it, whether you're going to get 180 or 190, didn't make that much of a difference. But up around I'll quote the 10-year, even though we're talking about the short end, of around 5. Now the market's expecting future Fed funds rate to be in a point where you're pretty much shutting off most of the excess spread, and that kicks in a lot of duration. So you go pretty quickly from 2 to 7 maybe. So that's why it's pretty dynamic. But as Brian mentioned, now we're coming off that that change, getting at least in the legacy space, they'll get a bigger kick from the rates going lower. And then eventually it'll settle into a bond where there's just not a lot of duration, if rates go down. You kind of settle in that universe.
It's like Brian and I have talked about before, the difference between a physics experiment and a biological experiment. Right? Physics, you just had a variable, you make some assumptions. Biology, you had a new variable. It screws everything up. You don't know what's going to happen, so you got to be on your toes and have some expertise behind it. I love it. Well, we went a little bit longer than I wanted to, but it was so worthwhile. This is such a great analysis of these things. Going to be super helpful. Brian, Garrett, thank you guys so much. Don't get sunburned, but get sun kissed. Enjoy the rest of your summer.
You too. Thanks, John.
All right. We'll